November 16, 1914. Federal Dawn. The opening of the 12 Federal Reserve Banks marked a major shift in United States financial structure. The event followed passage of the Federal Reserve Act in 1913, which responded to repeated instability in the banking system. Lawmakers wanted a central framework that could supply elastic currency, support bank liquidity during stress, and reduce the force of financial panics. The system blended national oversight with regional awareness through banks in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. Their launch introduced a unified method for managing currency and credit across districts. Each reserve bank began operations with the authority to discount eligible commercial paper for member banks, issue Federal Reserve notes backed by those assets, and hold reserves for member institutions. Before 1914, banks depended on scattered reserves and faced seasonal pressure when money demand surged. The new system gave banks a steady source of liquidity. This change improved stability because banks could turn reliable assets into cash rather than cut prices or restrict withdrawals. It also concentrated reserves in secure institutions rather than leaving them spread across correspondent banks that faced their own risks. The design of the system reflected a balance between public and private roles. Each reserve bank operated under a board of directors that included representatives from member banks, commerce, and the public. This structure aimed to reflect district conditions while following policy direction from the Federal Reserve Board in Washington. The opening ceremonies showed this blend as local business leaders, bank officers, and officials marked the start of a coordinated national institution guided by regional knowledge. The launch directly answered weaknesses exposed during the Panic of 1907. That crisis grew from limited oversight, shallow reserves, and heavy seasonal demand that led to bank runs and a sharp contraction in credit. The reserve banks created a currency supply that could respond to real economic activity. They issued notes tied to commercial assets instead of relying solely on gold or government bonds. This flexibility improved the system's ability to expand or contract in step with business conditions. The opening day was more than a symbolic start. It served as the first test of a structure built to prevent the destructive cycles that had damaged growth and public confidence. The reserve banks also formed a national network for clearing and settling payments. Before 1914, interbank settlement often required slow and costly transfers of cash or gold across long distances. The new system created a more efficient clearing process that reduced friction in regional markets. This improvement supported commerce by lowering transaction costs during a period of rising interstate trade. As checks moved faster and balances settled more smoothly, businesses benefited from greater speed and accuracy across financial channels. Another important outcome came from the steady flow of data the reserve banks collected. Their formation created a structured stream of information on banking and economic conditions within each district. This reporting strengthened the ability of the Federal Reserve Board to evaluate credit and adjust policy. The Federal Reserve now worked with clearer insight when setting discount rates, managing reserve requirements, and supervising currency issuance. The opening of the banks thus marked the beginning of a more informed central authority. The launch of the 12 banks did not complete the development of American central banking. Later changes, including the Banking Acts of the 1930s and the formation of the Federal Open Market Committee, added further tools and guidance. Still, the events of November 16, 1914, stand as a foundational moment. The opening marked the first day the United States operated under a central banking system built to support stability, secure liquidity, improve payments, and gather continuous economic intelligence. The new reserve banks signaled a national commitment to a more orderly and responsive financial structure. Their introduction reduced fragmentation and strengthened the country's capacity to manage credit and currency in a clear and unified way. For enthusiasts of historical ephemera, visit history-collectors.com to find collectibles that might complement your collection. You can own a piece of history.